Warren Buffett has done it again. With a portfolio worth billions of dollars, every move he makes is scrutinized by investors and analysts worldwide. But what do his recent decisions tell us? Why did he sell shares of giants like Apple and Bank of America? What drove him to buy stocks like Domino's Pizza and Pool Corp? And most importantly, what does his strategy of hoarding record amounts of cash mean for us as investors? In today's video, we'll analyze every detail and try to uncover the logic behind the choices of the Oracle of Omaha. Get ready for an insightful journey into the world of investing with the best mentor possible. Let's start with the sales because there have been some truly surprising decisions. The most shocking is undoubtedly the significant reduction in Buffett's stake in Apple, one of the pillars of his portfolio. He sold a whopping 100 million shares, reducing his position to 300 million shares. But here's the thing. Apple is still a massive holding, valued at approximately $69 billion. Why sell then? There are several hypotheses. Buffett may have decided to rebalance the portfolio, as Apple represented a disproportionately large portion, potentially exposing him to too much risk tied to a single sector. Alternatively, he may believe Apple's current valuations are too high, especially in a tech sector facing new challenges such as rising costs and global economic uncertainties. Apple wasn't the only stock affected by his sales. Buffett also significantly reduced his position in Bank of America, a stock that has historically been one of his favorites in the financial sector. But that's not all. He completely exited his position in Floor & Decor Holdings and nearly exited Ulta Beauty, two companies in the discretionary consumer sector. This series of sales suggests Buffett is taking a cautious approach, reducing his exposure to sectors that may be vulnerable to an economic slowdown or that have valuations deemed too high relative to their future growth potential. Now let's move on to the buys, which as always offer fascinating insights into Buffett's perspective. Once again, the Oracle of Omaha surprised us with choices that may seem unusual but are highly strategic. Domino's Pizza. One of the most talked about new buys is Domino's Pizza, with a $549 million investment to acquire 1.28 million shares. But why a pizza chain? In reality, Domino's is much more than a food company. It's a business model built on operational efficiency and technology. Domino's global network and its ability to quickly adapt to new trends, such as the surge in home deliveries, make it a highly resilient company. Buffett may see Domino's as an opportunity to capitalize on a stable sector with attractive margins, even in uncertain economic times. Pool Corp. Another intriguing new investment is Pool Corp, a company that distributes pool products. Buffett invested approximately $152 million, buying 404,000 shares. Why such a niche sector? The answer could be market stability. Pool Corp operates in a segment that, while not glamorous, offers high margins and consistent demand, especially in the U.S. pools, remain symbols of comfort and luxury, and Buffett may see this market as a defensive choice at a time when other industries are more exposed to volatility. Heico Corp. Finally, Buffett increased his stake in Heico Corp, a company that manufactures aviation components. This move is interesting because it reflects a long-term vision. The aerospace sector is still recovering after the tough pandemic years, but with the return of travel demand, Heico could represent an opportunity for sustainable growth. Perhaps the most fascinating aspect of Buffett's recent moves is the record-breaking level of cash accumulated by Berkshire Hathaway, $325 billion. This staggering amount raises many questions. Why is Buffett stockpiling so much cash? And what does this tell us about his view of the market? 3 reasons for hoarding cash. 1. Overvalued markets. Buffett may believe that the stock market is currently overvalued. With the S&P 500 at all-time highs and many companies trading at high multiples, he might prefer to wait for more attractive valuations. 2. Waiting for opportunities. Buffett is famous for his patience. Hoarding cash means being ready to seize extraordinary opportunities, as he did during the 2008 financial crisis, when Berkshire Hathaway made decisive and highly profitable moves. 3. Potential big acquisitions. Another possibility is that Buffett is planning a major acquisition. With such a large amount of cash, Berkshire Hathaway could acquire an entire company or make a significant investment in a new sector. What can we learn from these moves? Here are some key takeaways every investor should consider. 1. Patience is a virtue. Buffett doesn't get swayed by market hype or pressure. He knows how to wait for the right moment to act, and this is one of the main reasons for his success. 2. Risk management and rebalancing. Reducing exposure to overly concentrated holdings is a smart strategy to manage risk, even when dealing with high-quality companies like Apple. 3. Focus on fundamentals. Buffett invests only in businesses he understands and that have solid business models. This approach protects him from short-term market fluctuations. 4. Be ready for opportunities. Hoarding cash doesn't mean not investing. It means being prepared for the best opportunities. So what do you think about Buffett's decisions? Do you agree with his strategy of reducing risk and hoarding cash? Share your thoughts in the comments below. I'm curious to hear your opinions. If you enjoyed this video, give it a like, subscribe to the channel, and hit the notification bell so you won't miss any updates on the world of investing. Remember, as Buffett says, the best investment you can make is in yourself. See you in the next video.